I love learning more about you and your family and your values. And today we're going to continue to talk about life, but we're going to plug the numbers in, which
Okay.
I know, Gene, you've been the spreadsheet person for a while, so I'm sure you'll enjoy the numbers. And Rick, this might fill you in a little bit if you're not as
That's a
aware
good
about kind
possibility.
of.
Yeah.
I remember last time you said, at least in the past, you weren't quite sure where the money was in terms of the credit union.
That's a fact. That has been a truth for a while.
It'll be really nice to kind of put that island of qualitative, your values and desired outcomes, and now talk about this island over here, which is everything in your life with a number on it. So I saw you uploaded 32 documents. I've reviewed all those and summarized all of those. So today we're going to clarify the accuracy of some of those. I've also developed some follow-up questions that go more into the qualitative side as well. We'll be switching back and forth between the numbers and life, but ultimately they're going to be aligned together, all playing the same game. So I'm
Okay.
excited to dive in. Moving into the numbers, we're going to review your current and future income sources from all various different places. Also, your current versus future expected expenses, your investments, your total portfolio broken down into those tax locations of the taxable, pre-tax, and tax-free accounts. And we're also going to talk about taxes and Roth conversions, which, at least from the initial glimpse, I've run some scenarios that we're going to cover next time, but Roth conversions will most likely become a part of your life in the
Oh,
next few
okay.
years. In terms of building a base case scenario for financial planning, I know, Gene, you've used financial planning software in the past. It had some limitations, at least from the tax location side.
Yeah. I mean, they were very simple ones through Vanguard or Fidelity or that kind of a place. And I felt like they were not, as robust as I would have wanted.
On our next call, we're actually going to be diving into an advanced software that does allow for all those complicated things that are hard to make into are hard to establish within a spreadsheet. Right? When we pull different levers of add income or take away income or add a pension or take away a pension, you can visualize the possible outcomes. All we know is that the numbers will be wrong because we're making assumptions.
Yeah.
But one of the things that I like to do today is to mutually define those expectations and those assumptions so that when we go into the software, we can focus on the output, not as much on the input, because we know you've checked all of our boxes input
Gotcha.
wise. So in terms of income, you're only assuming the base salaries of 250,000 combined. So I'm going to start there as a base case, and then we can always add bonuses later. But I think that's a nice conservative estimate for your gross income while you're both working.
Yeah. And I think the question there is how long are we both working? So,
Right. At this point, you are work optional, where you work because you want to, not because you have to. But it'll
yeah.
be nice to be able to pull those levers and say, what happens if we never earn a paycheck ever again, and we only just take our money out of our accounts and pay ourselves from pensions. The numbers that I'm going to reveal to you today, at least the general numbers, it's very conservative in terms of you're paying state tax. It's also going to assume that yes, you are taking money out of those tax deferred accounts. I put life expectancy of age 95 for both of you.
That's good. Yeah. Whether it's realistic or not, I think, again, we'd both rather have the assumption be there so that you're, you know, covered.
One of the future income sources for you that's going to be pretty significant is Social Security.
Mhm.
So looking at your Social Security, your combined benefits, once you're both are claimed, going to be between 80,000 and 100,000 per year. And that's inflation adjusted through the end of life, of course, jointly. The surviving spouse will continue the higher benefit, which is going to be around $53,000 a year, which is, Gene, that's your estimated benefit if you claim at the latest age 70.
Okay, that's what I was wondering.
Yeah, based on the general assumptions, I do think it makes sense for at least Gene, you to claim as late as possible, and then we can talk about Rick possibly, claiming your benefit before that. A big part of that scenario will be whether or not you do Roth conversions, because the longer we have control over taxable income, up to 85% of Social Security will be taxable. It might make sense to actually defer that income. We can even pull this as what happens if there's no Social Security, right? And if your plan still works without Social Security, then maybe you just see it as this kind of, let's just take advantage of the inflation adjusted growth, or take it earlier, but earmark it for giving maybe to your kids, or to charity, or right. So there's a lot of great things you can do in terms of pulling those levers.
Okay, good.
Maybe your shoulders are already coming down a little bit. You're like, wait a minute, Cody just said Social Security doesn't matter for us. That's pretty nice.
Yeah, what a
Uh,
blessing to be in that kind of a position,
Yeah,
right?
it is.
Absolutely. I know, Rick, last time you talked about when I asked you about the 5.8 million, which by the way is now over 6 million and just in the last 3 weeks has gone up. You said your initial thought about that number was like, wow, like we're blessed and not everybody has this opportunity.
I think we are. We're pretty fortunate. Gosh, you just look around. I mean, there's an awful lot of people that have lived paycheck to paycheck for many years with little or no savings. And I think that's kind of the norm, unfortunately, in the country, seemingly. So, yes, we're pretty blessed in that regard. I mean, there are people that are way better off than us, but there certainly are many, many people that are far worse off than we are. And our needs are not extravagant by any stretch. So I think that we're in pretty good shape.
I love that you have that sense of gratitude about, hey, like we've been given this opportunity, not just to have money, right? But all of the experiences and opportunities from your perspective, thinking about God's plan for you, being a good steward of this money for you, your family, your church. It's going to
Mhm.
be amazing how much can happen if you're willing to just go a little bit deeper into that intentionality. Through this data, we can turn kind of the black and white data slowly into a transition of kind of opening your hands to give and receive even more,
Mhm.
financially and otherwise.
Yeah, yeah. I think so too. I mean, I feel like I have been able to do that a bit. He would probably say not as much as he would like. Um, Even just in the last couple of years, just, like we talked last time, kind of we reached a number where I'm like, okay, I think we're going to be good, and so not sweat the small stuff.
Mhm.
Some of it is just natural. It's so ingrained that I can't help it. Um, but I think that I have gotten more comfortable with like, yeah, that's fine. I'm not going to
Mm.
worry about that.
I know a big part, especially Gene, since you're working with the numbers a lot more. It's going to be really nice to have some systems in place.
I was talking with a family member this weekend and saying, that we were going through this process, and a lot of what I wanted to understand was, some of these strategies to minimize taxes or, to manage a Medicare premium. But on the other hand, it's like I don't have to go to extremes for it because, we have sufficient funds. And so, I don't want to be like, oh, we can't do this because then our, taxable income will be too high. So, that's
Mm.
another area where I feel like in the past I would have been like, oh, I want to, maximize, you know, to the extent we can, or minimize, whichever way you want to say it, maximize what's ours and minimize what we give to the government. But now I'm like, I'm not gonna stress over it as much because it
Mhm.
isn't going to make or break our situation.
I absolutely agree. I think that you're in this place of the 90%'s there. Now it's optimizing that top 10%, where just like you said, whether you stay in your state or income taxes go higher. I also have an assumption that the Tax Cuts Jobs Act, like those more aggressive tax
It's
brackets,
going
hit
to
you in
revert.
starting in 2026. So we can even pull that lever even closer. But it's nice to know that, hey, like even if those things happen, your plan works. So
Yeah,
that 10% of optimization will just be like I said, give more money to your family and your favorite charitable organizations and give less money to Uncle Sam.
yeah,
Right, right.
yeah. Yeah, I think it would have to be kind of a really bad economic situation for us to get to a place where, we were worried about what are we going to do, as in our old age.
Sometimes there's a lot of anxiety around turning assets into income because we've been doing the opposite our whole life. For the last 40, 50 years, you've been turning income into assets. And now you're like, how do I turn assets into income? Because nobody taught me this in school. And it's also been a long time since we've been in school.
Yeah. Well, thanks. Thanks for reminding us of that.
Now you're going to YouTube and Facebook University, right? In terms of
Yep.
learning more about retirement income planning.
Yeah. And it's not as easy as it once was.
No.
Mm. I think the conversation about where you live moving forward certainly goes beyond the financial things. I think as both of you mentioned, there's a church connection. Rick, you'd love to golf with your buddies and have maybe a breakfast group and kind of figure out what that looks like. Maybe it means having two homes with maybe the primary home being in a tax-free state, moving in, once you don't have earned income. So I think that will be a continued conversation, going beyond even me in the room. But I just want to mention to you, I am thinking about that as I make these plans, create plans with you. The base case scenario I have right now is that none of your real estate is liquidated. But we can, if you'd like, we could create a scenario together where you buy a new property in a different state and all those things. I don't really think it makes sense for you to mortgage a property. I think if you were to buy even, let's say you buy even like a $400,000 home in a different place, I think cash would make the most sense, whether or not you sell your current property or not. So I just want
Yeah.
to give you that heads up that I don't think debt will be in your future.
That would be kind of my instinctive answer as well. I couldn't see entering into a mortgage situation now when we've been without for so long.
Yeah, we haven't had one for 20 years or whatever at this point. So,
Yeah. Well, not quite that long, but
well, it's
yeah.
been a long time.
It feels like you're kind of backpedaling if you go back into debt,
Yeah,
right?
it's just the
Yeah.
idea of going into debt again, I guess, is something that I don't think I feel that great about doing at this point. I'd
Yeah.
rather just pay for something and it's done and we're clear and it's not a problem.
One of the notes I have here is, Rick, you mentioned that you want to buy a new vehicle, SUV or a pickup, something that you don't have to worry so much about hitting your head or injuring your neck after your surgery. Have you researched those options and maybe set a timeline for when you might buy that new car?
I mean, I have, and I would guess it probably would be in 4 to 6 months at the most. That's what I have in my
Great.
own head. I'm not going to buy one right this minute. Probably not this summer even. It might be more towards the end of the summer, early fall. But I do believe at some point in time I'll pull the trigger and get something else just because it's an annoyance. It seems crazy to some people,
Mm-hmm.
but it's just my own particular situation with my neck,
Yeah.
and it's just like it's just my own deal, I'm afraid.
Mm.
But yes, anyway, it's a few months down the road. It's not an imminent purchase by any stretch. I
Mm.
mean, I don't know. It's a $50,000 vehicle or something like that. It seems to be what their going rate is for most of those things. So, give or take, that would be
Right.
the idea, I guess, down the road here.
Well, there's a concept that my therapist counselor mentioned to me. We actually ended up naming it. We call it the cost of coping, which is sometimes having a more comfortable situation is worth the money. Right? Return, the return on hassle is worth it. So
Yeah.
yeah, if $50,000 is going to avoid a future injury, like that's a drop in the bucket in terms of your
Yes, it
total
is.
circumstance.
Yeah.
Yep.
In terms of your investments, so last time we talked, I mentioned 5.8 million. Now it's 6 million. So I mean, as you know, right, a week or so it can go to that. A week later it might be 5.5. Right.
Yeah.
We're not really focused on short-term outcomes with long-term money. I'm glad that you're already thinking about sequence of returns risk. We'll talk about retirement distribution strategies in a moment to really talk about, hey, like how do you go into retirement with a systematic retirement distribution strategy, but also you don't have to base whether you get dessert with dinner on how the stock market did yesterday. Right now, that if I were to squish all the accounts into one portfolio, it would be about a 60-40 portfolio. 62% equity, 38% fixed income and cash. That's actually split between 3 tax locations. So 34% of that is in taxable brokerage, 53% of that is in pre-tax, tax deferred accounts, and then 13% is in tax-free, those Roth accounts. So I think you have a really nice balance, having over half of the 6 million in tax deferred, pre-tax traditional retirement accounts. I have a light bulb above my head that says, hey, Roth conversions, Roth conversions. Especially you might have maybe a decade of flexibility over your income, especially depending on when you claim, depending on when you claim those pensions. So I just want to let you know that the numbers great, but also the balance. Don't really think too much about how it looks today. Really, we're going to make a plan for how we want to shift that asset location moving forward. So as you spend money in retirement, you'll be unwinding some of your taxable brokerage accounts and checking and savings. You'll be decreasing your pre-tax accounts, but mostly to increase your tax-free accounts. So I do think that Roth conversions will be a big part of your plan. Even in the scenarios that I've looked at so far, we're looking at in today's dollars. Again, we don't, all we know is that these numbers will change, but at least in the estimated scenarios, by doing intentional Roth conversions, you're looking at saving around $1.3 million in taxes in today's dollars just by having an intentional strategy in place. We'll actually visualize all those scenarios during our next call, but I want to just let you know that Roth conversions will be a part of that plan from every angle that I've seen it so far.
Okay. Sounds good.
So looking at your various investment accounts, I want to kind of go down the list, and we're not going to cover every account with every dollar amount, but there are a few highlights of opportunities across each tax location. Starting off with the taxable brokerage, the taxable accounts. What I mean by taxable is that they're taxable along the way, right? So the dividend and interest income and the capital gains distributions within your taxable brokerage account, and then also the interest income within your checking and savings accounts. So you have about 2.1 million in the taxable brokerage asset location. You currently have about $200,000 in cash, and most of it is receiving about 4% interest, which I'm glad that you got the high yield
Yeah.
APR going on. How much cash do you prefer to set aside, and is it earmarked for specific purposes?
In my view, it was in lieu of bonds. They talk about for that mix
Mm,
of conservative and aggressive investments. I don't like bonds because interest rates have been so contrary to historical situations for quite a while.
mm.
And so the availability of the high yield savings was kind of my alternative to doing that. So that's why we've had as much as we have in there. And we've had points when we probably had a little bit more. Rick's been talking for a while about another vehicle and, some of those kind of things. And for a number of years, we had kids in college and needed funds, to cover tuition and things like that. It just feels better to have something liquid
Right.
and available if needed.
Yep.
So you mentioned that phrase, "I don't like bonds." I at least interpret that as I don't like interest rate risk.
Yeah, I don't like that inverse relationship because for a long time interest rates were so low they couldn't go any lower, and so bonds had no upside potential. So that was kind of my
Right,
perspective.
right. As we talk about retirement distribution strategies, I certainly think you do need some fixed income within your portfolio, and you already agree, and you have that in various accounts. We might talk about buying bonds, but buying bonds that aren't subject to interest rate risk. What I mean by
Right.
that is actually buying bonds, whether individual bonds or bond funds, but laddering them so that you're actually holding to maturity rather than being influenced
Right.
by what's happening with the market.
And I'm more open to that, but just hadn't gone through the exercise of doing it for us in the accumulation phase. I've certainly been reading more about it lately and seeing that, there are some people who are just, as you said, very systematic and have that. And it's like, we have this maturing this year and that's our money to spend, and kind of having that in place for long term sources of funds.
I'm going to provide specific investment recommendations, including tickers for you. And I think that you're like me in a way, kind of thinking barbell approach of like, I want my bond part of the portfolio, fixed income, to be stable. I'm not chasing growth and income with this part. I'm chasing growth and income with the stocks. Kind of taking a barbell approach of
Yeah.
like low risk and high risk, not just everything kind of floating in the same boat together.
And I think, you said we're about 60-40, and I would say that's reflecting that because I thought we were at about 50-50. But there has been, some
Hmm.
um, recapture through the equities. And so I'm not surprised that we're a little more heavily weighted there. But I'm glad that, I know that we have a chunk that's pretty well, set aside, maybe not doing much more than hopefully keeping up with inflation, but certainly not declining quickly. So it's like that's the foundation, and the rest of it is where we can grow and do even better.
Gene has done a great job with the portfolio with how it looks today. What I mean by that is if I were to just review this as like just a stranger's portfolio, I would assume they're either very highly educated or they are currently working with a financial advisor who knows who's also highly educated. So I think that most of what you're doing makes a lot of sense. Often when I work with people who are really frugal, they're great savers. They're great savers, but they aren't great investors, right? So it's really nice to see that you have put that money to work.
Well, thank you.
And sometimes it's nice to hear in terms of spouses being affirmed for the hard work they're doing. Because sometimes looking at a
Good
spreadsheet is like
job.
a silent, yeah, like get the nice pat on the head.
That's right.
Sometimes working with spouses, especially, sometimes they view their job as moving investments. Our last conversation, you mentioned that you don't like that idea of even hiring somebody else to just move money around constantly. Like that's not the way you like to manage your money. I'm glad you don't find your identity or your value in life to like how often you move money around or which investments you choose. I would like for you to be more passive with your investments and be more active with your life.
Yeah, I know Rick has no interest, and neither do I, in looking day to day, like, how did we do? I think I said
No.
last time around, it's pretty much a
Mm.
once a year thing right now. Now, maybe it would be different
Right.
if we have to be pulling money out, for living
Mm-hmm.
expenses or eventually for RMDs. But, I would almost rather not know, especially when the market goes down, because, all that does is cause regrets, and there have been
Mm-hmm.
times when he's like,
Right.
well, crap, we could have bought 3 new cars,
Yeah.
for what we
For
lost.
how
And
much we
it's
lost in
like,
the last couple of days.
you
Yeah.
know, it doesn't pay. That
Hmm.
isn't
Right.
worth having those, thoughts and
Mm-hmm.
regrets.
The phrase I use is don't make long term decisions based on short term outcomes. And also the idea of it's kind of like the more often you look at it, the more volatile it is or seems.
Yeah.
Yep.
If you look every day, you're seeing this, but if you log in once a month, you're kind of it's a little bit slower.
Yeah.
Right.
It's a smoothing
It's
process.
a less scary roller coaster,
Yes.
right? It's a
More
smoothing
calming.
process. The strategy I'm going to provide to you in terms of investing and also rebalancing and also distributing income will actually be like a semi-annual basis. So just June and November for 30 minutes twice per year again, and you'll have a systematic approach where you don't have to make any decisions based on how you feel or what the market looks like. It's just we have a philosophy with how we invest, and we stick with that philosophy because we know the numbers, right? We've done the analysis. But I really like that you're not taking that approach of turning your new job in retirement is like opening your accounts every day to look at what
Yeah.
opportunities there are,
Mm.
because as you know, it's like the bar of soap, right? The more you touch it, the less there is.
There you go.
Speaking of passive versus active, 10% of your total portfolio within the trust, taxable brokerage, and also Gene, your Roth IRA, you do have that real estate fund. And I'd just like to know, like, how did the real estate funds, kind of come into your life or come into your portfolio?
Well, it was, you know, through a talk radio program that I listened to where
Hmm.
they promoted it, but also the host, said he's invested in it. And I grew up in a farm community further back for Rick, it's that way, but where land, was kind of the safest investment. And for a lot of people, that's where all their wealth was. Even my mom held on to some farmland that she rented out, and we had talked different times, one time about buying from somebody I knew was selling, and it's just very expensive nowadays, and so it was more money than we necessarily had available and wanted to put into that directly. But being able to do it, our initial investment was with Roth IRA money,
Hmm.
and some of the benefits of that sort of investment, and just kind of their underlying approach resonated with us, and so we kind of took the leap. We consulted a few trusted advisors and got their opinions, and move forward, and then put a little bit non-tax advantaged money in as well, but kind of got to that point where it's like,
Hmm.
okay, no more. That was a percentage we were comfortable
Right.
Yeah.
with, and it's a
Mm.
less liquid investment. So that's part of why, too. It's like, yeah,
Right.
not knowing what the future will hold, we didn't want to get too tied down.
Mm-hmm. I think that in terms of sector, like I would have no problem with 10% of your total portfolio in real estate. I know that there's some diversification within the fund itself. It's not like you bought one property. With that said, in the numbers I'll share with you a little bit, I've also pulled the lever just saying, what happens if we just take that portion out
Okay,
too, just to give you a little bit more clarity on like, okay, like it's not about investment, but we have to make sure that it's not going to affect our scenarios.
good. I like that.
Moving from taxable brokerage now to pre-tax. So 401k, IRA, inherited IRA, the asset allocation of your pre-tax money, you have about 3.2 million there. It's actually kind of the inverse. It's like a 40-60 portfolio. You're being really thoughtful about tax location of like, if we're going to own bonds, like that's the place to own them because we're not going to be hit with that ordinary taxable interest every year. So in terms of going into the fixed income positions, I'll start with your newspaper 401k. It has about 1.7 million. 1.3 million of the 1.7 is in that stable value fund. Is that kind of like what you were thinking there as well? As I need some fixed income in my total portfolio, and this is the place to put it?
Yeah, absolutely. I mean, I think I thought at the time, like, oh, I should have done this a while ago, when it finally clicked, like, those are the dollars versus our Roth or outside of taxable income. And I guess I would say, other than holding some cash, there was a long time where pretty much everything was at risk. And, but it was just as I understood, now it's time to start moving more to a more secure place. And I forget when I made that change. I think it was at a time, maybe approaching an election, where I thought, okay, don't know what's going to happen. I'm just going to park.
Mm.
And I think initially I did like 50% of it, put it into a more stable kind of a fund. And then I did more.
Mm.
And to be honest, a little bit in that particular 401k, that is not. I think it's just because I missed it when I was
Mm.
doing the transfers, and it's been doing well. So it's like, okay, I'll leave that little bit where it is. But so more laziness than thoughtfulness, perhaps, in that.
So you mentioned two sides of decision making. You talked about how, hey, like, we're getting close to retirement. We might start wanting to think about creating some, cushion and, reducing our risk overall, sequence of returns and all those things as you learn about it. And then on the other side, you did mention some concerns about political things. What's something that could happen that could, politically, that might affect your investments?
The two things I've heard mentioned that probably give me the biggest pause is talk of tax on unrealized gains, which I think would just be
Hmm.
crazy.
For like the ultra wealthy, at least assuming, right?
Yeah, and not that it affects us, but I think about small business people, and one, they have to value their company, and then if there's a tax, they have to come up with cash to pay for it. I mean, I think it would inhibit
Right. Liquidity
growth.
issues, right?
Yeah, and it would hurt the country as a whole. And then I also worry about there's been talk of taking away the step up in basis, which,
Hmm.
at the end of the world. We've been lucky to inherit some money from family members, and I don't anticipate more of that. But I think about that for our children, to the extent we are able to leave some for them. That is one of the huge advantages for them. And if that goes away, it's already, even the inherited IRAs. People have a timeline; they have to claim it. If they, do away with the step up in basis, I think that's going to really hurt that next generation.
We're going to make decisions based on what's currently known and within our control. But I like that you're considering, like, what are some possible levers that could affect our plan, and how can we get in front of them in a way. Moving into the tax-free accounts, our favorite accounts, right? We love Roth. Are you
Yes.
big fans of Roth?
Wish we'd done it sooner, and
Yeah.
then we started hitting the income limits, couldn't do more. So wish I
Right.
had done the Roth 401k sooner.
I think everybody should have Roth, but it's not everybody should have Roth early on. You're in a great place to add Roth moving forward at lower marginal tax brackets than had you done it before. So you haven't missed out. You haven't missed the train. There's still a train waiting to go. The Roth
Okay,
train is ready for you. So
good.
that'll be a big part of your plan. Roth IRAs, great start. Rick, you have 365,000 in your Roth IRA, which is incredible. So we're going to be building those up even more. So now we've talked about income, assets. Now we get to talk about expenses. I know that
Okay.
some of our viewers might be a little surprised at the level of expenses given the asset size, but your after-tax living expenses, at least based on what you sent me, is about around $62,000 a year. About 70% of it is non-discretionary, like housing, food, transportation is the bulk of it, which very much means that of the money you're spending, it's mostly on essentials. Had you not done that for me, if I would have just asked you, hey, how much do you think you spend after tax per year? Like, I'll start with you, Rick. What's the number that you would have guessed?
I probably would have said about 75 or 80,000 a year, I think. So actually, I mean, that's probably paying less than what I thought. So, we certainly don't live an extravagant lifestyle, obviously. So our needs aren't that much.
You're like, thankfully, live in a low cost area, right? That's a big deal. Or
Oh,
except for state taxes,
Yeah,
yeah,
things like that.
yeah. Well, or the fact that, I mean, we don't have a mortgage payment, so
right.
that makes a huge difference.
Yeah. So moving into retirement, it's really nice to have that like flexibility of saying, hey, like we only, in terms of meeting our needs, you're only looking at 50,000 a year. Social Security is practically covering our basics. So what do we do with the portfolio? And it's really going to be a tax optimization play. And of course, giving yourself some courage and encouragement to start thinking, maybe dreaming a little bit bigger about what things might look like. There are two non-discretionary places that I think I would love to kind of encourage you to think bigger on. What would you like your assumption for charitable giving to look like? I think your assumption was 5,500. Is that the assumption you'd like to use as the kind of the starting place, or have you thought about giving more or less financially to charity?
I could see it going up,
I could see it going up.
or being something that you do well, and especially once we get old enough to do the contributions from the pre-tax funds, where you avoid the
Mm-hmm.
ordinary income. I
The
forget the term
QCDs.
for that. Yeah. It's like right now, not so much, but I could see when that opportunity, and assuming it's still available when we reach
Mm.
the age limit, then that becomes a nice way to do it because you got to take those distributions anyway.
Really moving forward, it makes a lot of sense to not give any more cash to charity, in terms of qualified charity. So only give appreciated stock, whether directly or through a donor advice fund. Is that something that you'd like to look more into in terms of just being more tax optimized with your giving?
Yeah. And especially given the changes in the tax law in 2018, it's like before you got some benefit from charitable contribution in whatever form. Now it's kind of because we don't have a mortgage, we're standard deduction and doesn't really matter unless we give a whole
A
lot.
lot.
I'll educate you on the use of donor advice funds, which is effectively a way to stack. Say, hey, let's stack 10 years of contributions in 1 year, and then give it to charity over the next 10 years, right? So we can kind of spread out the gift, but get the deduction all in 1 year. I think it'll be nice to give tax optimized, even if you don't itemize moving forward. One other huge place, right, to dream big is travel. So have you talked about what travel might look like in your first year of retirement?
The length of time that we would go someplace is more likely to increase. Therefore, you're going to,
Right.
Yeah.
it cost will be up that much more. But, I could see us easily doubling that.
We're constrained by the fact that we work. And so once we're no longer
Right.
working, I think
Right.
then
That's
we've got some
exactly
deduction.
the case.
Mhm.
So,
Like it's hard to dream when you're still in this reality of like a nine,
right.
that regular 9 to 5.
It is a little bit.
Well, and even I mean, my work cycle or pattern is monthly. It's up and down, and so I can't be gone. 3-4 weeks at a time. Even 10 days is kind of gets hard because then you're catching up. Maybe we go 4 to 6 weeks
Right.
in the winter somewhere warmer. I don't want to own another place, but to rent
Mm-hmm.
longer term somewhere. And the nice
Long
thing
term rental. Yeah.
to be able to go different places each year too and experience some new places, maybe not to Europe
Mm.
because I worry about the fact that then you're far away if something happens to family or whatever. But, I could see going to South Carolina and Alabama and, Arizona, trying out those different places that are still a reasonable distance away if you do need to get back. And, warmer, and it breaks
Mm.
up the winter because the winters where we live can be brutal.
There was a conversation I had with somebody who's about to retire, and they were considering buying, second property for about $500,000. But what was nice is then they realized, wait a minute, instead of having one place for 500,000, how far could $500,000 go in terms of Airbnbs?
Long way.
Yeah, there's some pretty amazing places you could go, even if you spent your long-term rental or a month at a time.
Well, and I'm also realizing because we do have a second property back in the area I grew up, and that's been
Mm-hmm.
mostly me. Rick wasn't real enthused about that, but so I'm the
Mm-hmm.
one. I've got the worries like, oh, is it getting cold out there? Do they lose power? What about if this happens or that happens or it's storming? And that's a burden, and that I don't want for a place that's hurricane prone or that I can't get to
Mm-hmm.
without hopping on a plane. So another part of your hassle
Right.
factor is like don't want that hassle.
No.
You don't want to lose sleep over something that should actually provide ease and comfort to your life.
Yeah, the convenience of having a place where it's your stuff and you don't have to haul everything because it's there. It is not outweighed by the worry that would come with it.
Moving forward into retirement. So, with Social Security and the pension income from Eugene, plus your investment portfolio, your retirement strategy can actually support an estimated after tax living expenses annually of $275,000
Holy
through
cow.
age 95, inflation adjusted, and that's separate from earmarking $450,000 for 3 years of long term care.
Wow. That's that's amazing.
I'd have to see those numbers to believe them, frankly, but
Yeah.
it's a nice thought.
We're definitely going to visualize and understand like how did those like you didn't just get like the eight
What you
ball,
been
right? You actually like
smoking?
put
Yeah,
this in,
yeah, exactly.
right.
What even smoking down there?
Next conversation, we're going to I'm going to show you the real data, show you the numbers, show you the variables, show we're going to pull some levers. Just for now, with that said, if you actually could spend after tax, 275,000 a year, which means effectively adding $15,000 a month to your expenses. Initially, we might think, oh, like that's a lot to spend, but that also means maybe that's more money you can give either to charity or to your family. Let's have an experiment. If you had to spend, if you were forced to spend an extra $15,000 a month, what the heck would you even do?
That's a good question. I don't know what we'd do. I mean, we'd give away some of it. Not all of it probably, but I don't know what we would do.
Yeah,
I mean, we don't,
I would say I don't think I could
I don't
because
think we could.
I don't feel like there's much I want. And
Yeah,
Right.
I'm at the
not like
point in
that.
my life where I want less stuff,
Yeah,
you
I think
know.
we're ready to scale back as opposed to add on.
Mm,
We don't need a big
mm,
house. We've never been into fancy cars or second, the place on the lake kind of a deal. Um, that's just not our lifestyle. It's just not us. But I mean, we probably, I don't know, maybe we'd give some money to our kids or something a little bit more sooner or something like that, or put it away in savings for them. I don't know what else we'd
Yeah,
do.
I mean, that's kind of a phenomenal number, and I would never be comfortable spending to that level.
Oh,
But I
I
think
wouldn't
it
either.
certainly gives us permission to do more, you know.
Well, it probably gives us permission to, you know what, if I want to go buy a car, again, when we buy a
mhm.
car, we drive it for 10 years, kind of a deal. We don't buy a car and then
Right.
get rid of it next year, kind of a thing. You could just do that without worrying about it, which is something that I wouldn't say has
Mm,
been so much the case in the
Well,
past. But
I don't think it's that we worried about where the money would come from, but I think, at least for me, it's been more of a cost benefit or pleasure benefit. I don't
yeah,
get that much pleasure out of having the new
mhm,
thing every year or whatever. And I
right.
think of, you're gonna
Mhm,
hate me telling this story, but at one point, Rick's brother wanted to give him a nice gift, and so they decided on a dining room table, and Rick looked and chose and whatever, and had to order, and it finally arrived, and then was so wound up about if the girls put their backpacks on it because you might scratch it. It's like, to me, that's not worth it. I want to you know
mm,
not have to worry about those things just because it's new and you want to keep it nice forever, or
mm.
a ding or a scratch on the car, same thing. I'd almost rather start with something that's not perfect so that I don't worry about the moment when it becomes not perfect.
Yeah, I remember growing up with this idea of like, I don't understand decorative pillows. Like, why would you buy a pillow you're not allowed to lay down on? Like, you're not allowed to put your head on this. Like, yeah. So it's like kind of like that. Whether it's a dining room table or like the car, you're like the car that has to be like pristine and covered with a cloth. You can't even see the car because it has to be so pristine.
And it might not be the motivation, but to me it feels like sometimes the motivation then is to impress other people,
no,
and I'm past the point of
Right.
don't care.
needing or
Mm.
wanting to impress others by what I have.
Well, something that you can keep to yourself that doesn't have to be shown in public, and I'd put this quote here, is that you've effectively said less stuff, more memories.
Yeah.
I think that's probably true.
Not that you have to like four and a half times your expenses, but just kind of maybe give yourself permission and saying, what types of experiences or what types of memories do we want to create as a family? And then how does the money support that? I think if you start with the money, it's kind of limiting. But if you kind of push the money away for a minute and just say, if we had an empty full month calendar, no work, right? Get the idea of working out for a minute. Say, if we had an empty month that we could spend together, individually together, even with our other family members, like if we could just design an ideal month that just creates the best memories, what would that month look like? And then only at that point, bring the money in and say, how can our money support that? I met with people who they love the beach, but they always stay in the Airbnb that's like 10 or 15-minute walk to the beach. And I say, wait a minute, like your money can support you staying on the Airbnb where you open the sliding glass door and there's sand on your feet. I would love for you to start kind of dreaming about like what would that trip look like. Maybe your first big trip in retirement can be the one that you always saw somebody else do and you're like that would be nice but we'd never do that.
I think we may be at that level, but I don't think we're that kind of person. Uh, I would say I don't know that I would
No,
enjoy having somebody wait on me, or would feel comfortable in an opulent kind of a place. And to be honest, I get some pleasure from the planning process as well and saying, oh, look at this
Mm.
nice
It's a
Airbnb.
it's a game of frugality.
Yeah, well, a little bit, or just, I guess my experience has been too, if you get an Airbnb that's kind of like a home, it feels more like yours versus in a hotel room where all
Hmm.
you can do
Right.
is sit, there's a bed and a TV and of course, the bathroom and stuff, but it's like I don't want to just hang out there versus we've stayed in some Airbnb kind of places where it's like this is kind of cool,
Yeah.
and we've done some nice vacations, not elaborate, but we took our kids to France for 2 weeks and we took them to the United Kingdom for 2 weeks and we, traveled around to a few places, stayed a few different places. And it's like, well, this one was on the beach in Wales and this one, or on the water, not a beach, but on the water in Wales. And this one was an old, you know, house in the Cotswolds and we had a nice place in Kensington in London, and they were all nice places, but it was part of the game was for me of, ooh, look at this one and look at that one. And, how does that fit with what we want to do there, but still being, nice, but not,
Mm.
um, not
Overboard.
over the top
Yeah.
because we're just not
Mhm.
over the top people.
If you look out the window of your Airbnb, what do you see? So
Yeah.
imagine, Rick, right? That the next place you stay, you look out the window and you get to see that great architecture, like even when you go back to your hotel room. If we could go to Airbnb.com, but like not filter by cost whatsoever, would we still choose the same place?
Well, that's an interesting way to do it.
Yeah.
Yeah. Just kind of along those same lines, I guess I would say Rick never buys lottery tickets. I'll buy lottery tickets, a couple when it's a really big pot because I always say I want it to be life changing, not just some extra. But I also have always felt like I'm not buying it for all I could then have. I'm buying it for that security and the mental sense of I don't have to worry at all anymore.
Mhm.
In some ways, I feel like we're kind of almost there. We've won the lottery, in hearing some of this, but
Hmm.
that's kind of it. It's not that I want stuff or feel like my life has lacked. It's just that knowing I don't have to worry. I won't be a burden on anybody. We can take care of our needs
Hmm.
as we age.
Yeah.
That's where the great value is.
And if there's more left over, even if it's 10 million, we're okay with that.
Yeah, I think we can get to a place where we have what we want and what will make us happy, and it might be more than we have at some points in our life done or had. But I'm not going to go say like, oh, we got to spend, spend, spend either. I mean, I'd rather let my kids make those decisions than if I feel like we've had what we want.
This goes beyond the conversation. There's a lot of work that we have to do, including myself every day, in terms of thinking about spending. In terms of retirement distribution strategies, there are three approaches that I consider when I work with clients. One is called a total return approach, which effectively just means, hey, we're going to put our investments into just equity and fixed income. Every 6 months or every year, we just dynamically rebalance. We take money out that we need and we get back to whatever it is, the 60-40 portfolio or the 80-20 portfolio. Effectively, you don't make decisions based on the stock market. You don't set it up really with any emotional behavioral connection. You just say, we're going to set it up basic allocation. We just take money out as we need it. The second option is called a bucket approach, which is saying, hey, like we're still going to invest our money between stocks and stocks and bonds or equity and fixed income, but we're also going to set aside a few years of cash cushion, kind of like what you've been doing, to say, hey, we're going to have our portfolio, but we're also going to set aside like a 3 years of liquidity and stability. So if the stock market goes up and down, we can just focus on our 3 years of liquidity and not have to worry about what the market's doing. So that's the second approach. It's a little bit less rational in terms of the numbers, but it's a lot more reasonable in terms of the anxiety and that desire for safety and security. And then the third approach introduces annuities, which is effectively saying, hey, we're going to put a portion of our investments into an annuity. It's going to pay us, let's say, 7% of what we put in every year, through the end of our life. So you kind of create this guaranteed income floor, meeting your essentials, which Social Security in a way is kind of that for you. And then you have your portfolio, which is more aggressively invested for your trips and your, buying the new car and things like that. So of those three approaches, like the total return approach, the bucket approach, and the guaranteed income annuity approach, do any of those kind of spark spark joy for you or give you less, like give you more comfort than another?
I would probably go with number two.
The part I didn't understand is, are you replenishing that bucket every year unless there's been a downturn, and then you have the ability to wait a year or two before you do that? Now, if you're in a prolonged downturn, you're going to be taking money at some point out of those reduced.
Right. If it lasts longer than 3 years,
Yeah,
correct.
yeah.
Mhm.
But is that how you would do it? You
Right.
would normally we use a year, but we take money and put it into the bucket. But if things are really going south, that's when you're like, okay, hold off. I've always been kind of intrigued by annuities. And then you read somebody who's like, that's good only for the salesperson.
Mm,
And I maybe would have still been somewhat
mm,
interested in that, except for how you started out saying, Social Security and your pensions are already kind of the frosting on the cake. Well, to me, they are the base that we have, and Social Security is inflation adjusted. So, you know, now I'm like, annuities, don't need those. So, that
yeah.
really took those off
Yeah.
the plate for me. And so, of the other two, I think if the market really takes a hit, we might have what's 3 years worth in that bucket, but I'm pretty confident we could make it last for 4 years if we needed to, kind of a thing. It's like,
I'm
I
sure
think
you
we're,
could.
yeah,
Right.
so I feel like that would give me more comfort in those down times, to just be able to say, you know what, I can kind of not pay attention, give it time to sort out because we've got what we need over here.
So during our next call, I'm going to show you how that system works, and I'll even show you how to implement it, like the first go around. When you said last time, I think we're good. I think within a year or two, you'll actually say we are good. You'll actually have that clarity and confidence to say we're good.
Having somebody from the outside look at it and say, "Oh yeah, you're good." Um, I mentioned I have a sibling, a brother who is a tax accountant, and he's who I turn to for a lot of advice and guidance on what we're doing. So another brother was an economics professor, and he asked his older brother, do you use a financial advisor? And he said yes. And the question was like, well, why? Because you know all this stuff. And he said, yes, but my wife trusts the third party, and we'll
Mm,
listen to what they say versus, when it's somebody too close, or even me questioning myself, it's like, I think we're good, but it just makes a big
mm.
difference to have that external validation, and it's like, okay, I guess we are, there.
And by the way, that's why we call it measure twice, right? To get that second opinion before you make that big decision. Measure twice, cut
Yeah.
once. The last question I have for you today, Rick, last time you shared, I love that you were vulnerable and shared this idea. You said, growing up, you heard all the arguments about money growing up, or just arguments in general, probably, right? But you said, you're not going to fight about money. Like that's
No,
just like off the table. You're not going to
I'm
fight
not.
about money.
I'm not going to do it.
As I'm helping you build these systems and implement, how would you prefer to be involved in the financial management moving forward versus how you've been in the past?
Well, I think that, I mean, if we really do kind of a rebalancing just a couple of times a year or something like that, to me, that's much easier to be able to, for me to grasp, if you will. I don't want to look at it day to day. I can't possibly do that. But I can understand going in there and
Right.
doing it once every 6 months or once every 4 months or something like that, and taking 15, 20 minutes, a half hour, whatever it takes, just to review some things and get a better feel for it. I'm fully in favor of that. I mean, and I like that. I don't like
Yeah.
being in the dark completely on stuff. I mean, I've left a lot of
Mm-hmm.
things up to Jean. I mean, she's an accountant. She does this kind of stuff day in, day out. And I just don't enjoy a lot of it, frankly. Going forward, to be able to have that and feel like, that I can get a good grasp on it every couple times a year and feel comfortable with it. To me, that's kind of a
Mm-hmm.
good place to be at, I think.
Yeah.
I feel comfortable with where we're at and this kind of an approach where, again, like you say, hey, if you just look at this thing occasionally, you're not going to dwell on it. You're not going to lose sleep over it every night, kind of a deal. And that's where I want to be at with it. And I don't want to be fighting about money with my wife or anything
Mm.
like that. And I think, all the financial decisions, I think we're pretty much, we're not butting heads, against each other, for investing things. We talk it out maybe more or less than other people do, but I think I get a feel for what's going on. And that's really all I want.
Yeah.
I don't want to do the day
Mm.
to day stuff on it. So I think I'll feel pretty good about it, frankly.
Yeah. Whether it's just you two, whether it's with me, whether it's with another financial planner in the future, at least the first few years of retirement, I do suggest that you have kind of somebody else walk alongside just to help you gain. It takes a few years to gain that clarity and confidence to say, we got this, we're good. You'll have your own rebalancing calculator where you type in your numbers and it tells you what to do. I'm really glad that you're both going to have that agency to say, hey, like I'm not, neither of you will be in the dark. And it's something where when you do talk about it, it won't be conflict. It'll be like, oh yeah, we're on the same page. We're playing the same game. That's really exciting to me that you'll have kind of that insurance of if something does happen to one of you, that the other doesn't feel in the dark suddenly, that you can grieve the person, not grieve the system, because the system, you don't want the system to take away from your time thinking about the things that really matter. So
Yeah.
this has been great. I had a lot of fun so far.
Yeah, this was a good
That was
session.
a
I
good
think
session. That was, yeah, I liked it.
really helped kind of let go of fears and
A
worries.
few
So,
anxieties there, yeah.
yeah, it's great.
That's
And
good.
now you can have a nice. Are you going to go out to eat tonight? Get dessert too.
Well, I was thinking, we were talking about going out for a walk. It's like, oh, we got some stuff to talk about.